This recession has challenged a lot of conventional wisdom, like the idea that housing will lead the way to recovery. And Dan Alpert of Westwood Capital says, do not be misled. The housing industry and the banks that finance it face a huge hurdle. You know, Dan, good to have you with us. Thanks for coming in. You know, you're taking some time off from penning those op-ed pieces for the New York Times. In reading that piece, actually, you kind of waved a couple of yellow, if not red flags about the housing industry. What's the outlook right now?
You know, have been consistent since the very beginning of this crisis. The danger here is that we fill the banks with sufficient capital to just merely survive, and they sit there and they roll the hoop on the resolution of loans. That's what's been going on at least for the last 3 or 4 months, probably for the last 6 months, and the loan modification statistics, the foreclosure statistics all bear that out. The fact of the matter is, from peak to trough, we're going to end up losing more than what even I projected a year ago this month, of 28%. We're going to be down somewhere around closer to 40%.
And when you say losses of home prices?
Losses in home prices.
Right.
And that will translate into somewhere between $1.5 trillion and $2 trillion worth of mortgage losses. That problem is going to be exacerbated when the commercial mortgage losses start to trickle through the system. So you really have to look at this as something that's going to have plateaus and then additional dives.
Sounds like the geography of the West, you know, those old movies where you see those mesas, right? Those buttes, right? Is this going to be the butte economy? I mean, what's going to, is there any possibility that we're going to be able to avoid this? Are the banks do they feel that they can just insulate themselves from this?
Well, I think they view time as being their friend. Right now they're looking at their balance sheets and they're saying, we really don't want to take these losses now. In fact, it's really good when we show up with good earnings every quarter, because then people want to buy our stocks and we can issue more equity. We would be foolish, speaking as the taxpayer here, we would be foolish to stop that little routine. The more private capital that finds their way into the bank, the less the government has to put in. And that's the best way of recapitalizing the banks over time. The losses, however, will ultimately percolate through. You know, we've come out with some statistics on housing right now that show the bubble as being something that is readily identifiable, both in terms of what happened historically, but also in terms of where things are heading back to. This is a very huge secular shift. We're talking about something that began as a practical matter in 1997. We had enormous gains, not just the 2001 to 2006 period, but 1997 to the peak of this particular bubble. You know, we saw housing values go up about 120%. And diverge from their traditional boundaries in terms of multiples of rent by an enormous percentage. From 1955, we've calculated, to 1997, houses as a percentage of house prices as a multiple of rent never topped about 13.8 times. And we went to the top of this bubble at near 28 times.
So from 13, we went to 28.
Right, and it took from 1997 to 2006 to get there, but right now you look at those numbers and they are coming right back to historical norms. We're in a position right now where I think we can conclusively say that housing will bottom out somewhere between 15 and 16% lower than it is right now.
When it gets to that point, though, does it start to bounce back, or does it just sit there for quite a while?
Well, if you want the verdict of history, the verdict of history is housing sits there within a band of about 11.4 times rents to 13.8 times rents. Rents haven't moved, and that's the problem.
Talk about the problem from a geographical perspective, I know, because you've been looking around the nation. We know what's happened in places like the Southeast, the Southwest. What are some of the divergences?
Well, you now see markets that have overshot. In markets like Phoenix, which is sort of the poster child, Tampa, Miami, etc. But Phoenix particularly, you're looking at a situation where the curve for Phoenix looks like this.
It's a bad curve.
It has crossed over. I don't know if they put Phoenix up on the screen yet, but it has crossed over the point where it is now no longer, there's Phoenix, it's no longer justifiable in terms of where rents are in that market. Now, rents could be tailing down. We could be in a situation, we still have a massive glut of excess housing units, and we could be in a situation where housing prices effectively continue to chase rents downward. But as a practical matter, right now, Phoenix is overshot.
So do we all end up looking like, I don't know, the Matterhorn, except we're on the downside of the slope? I mean, is there anything to stop this?
Well, yes. I think at the point where the after-tax cost of carrying a home is equal to or less than the cost of renting one, it stops. That's it. That's the floor. And that's, in fact, where housing should lock itself into, because anyone who looks at investment theory understands that when you buy something, you buy it for current value plus an option on future growth. What happened in the housing market is the option on future growth historically was very small. It grew to more than 50% of the price of homes. People were essentially saying, I'll pay 50% for shelter and 50% for this wonderful option on future growth. Unfortunately, they did that at the top of the bubble. Very bad bet.
You turned their house into a derivative.
That's exactly right.
And so what do you prescribe? What is the Obama administration doing or not doing to try to at least forestall some of the excess pain, or can they not do that?
Well, no. I mean, the primary issue right now is whether this modification plan makes any sense under current circumstances. It may have been the right thing to do the beginning of this year. But right now we can look back, we can see that the foreclosures are continuing to escalate, and continuing to escalate, by the way, even into a theoretical recovery, right? Where we can look forward into that situation and go and look at what's going on with the modification program. It's being relatively ineffective. And so the question is, what needs to be done? Something needs to be done to stop this enormous run of homes into the sale market.
Well, we're going to have to leave it there, but I want to thank you very much, Daniel Alpert, coming in from Westwood Capital, sharing your thoughts about the housing industry.